We are looking for about a $40,000 bounce in the 200K portfolio. I want to show you why. In the portfolio calculator, we've had a maximum consecutive losing days in the past of 9. Yesterday was 8 in a row. We just transitioned to this setup, and it has a steeper drawdown. We have not incurred that much of a drawdown in real trading. We have rotated to this one at worst case drawdowns, and it's had 9 maximum consecutive losing days in a row in the past, and when it did that, it was at a lower drawdown level than we are currently. We've had 8 losing days in a row. These are the 8 losing days in a row starting August the 31st. Really choppy, and so this is my rationale. Is we've seen months where in the past you have months where your tendency for good trading is the beginning of the month, and then in the middle of the month it's more choppy, and then again at the end of the month you have good trading opportunities representing equity curves during good trading opportunities and less choppy markets. And then what we've seen recently is an inverse of that, kind of a mean reversion of that pattern. Choppy at the beginning of the month, and then middle of the month it does well, and at the end of the month it chops again. So it kind of mean reverse opportunities have been more in the middle of the month. And in August, we just saw chop. We just saw tough trading opportunities most of the month. So July, it was kind of like this. In August, it was just like this. And so I'm looking for a potential return to this choppy at the beginning, opportunities in the middle, and then choppy at the end. It's had 9 losing days in a row and historically, and we're on our 8th as of Friday. Good, strong comeback on Friday from the worst levels, and that is one reason why. We've also seen more two-sided price action. So once again, this drawdown is 38K, looking for a bounce back to that. I'm going to show you the charts in a minute. We've been trading the strategies where we transition from one portfolio to the next. We had the 200K portfolio November 30th through June 30th, so we stayed with most of the year, the first half of the year. Then we made a change to our AT 2020 strategy, which did well yesterday. It went from the .D symbol to the 24-hour symbol, and that was the main change. And so then July 1st through August 13th, we traded that setup, and then we had a change again on August 16th through September the 8th, and then we've changed again to rotate to this portfolio at a drawdown, at worst case drawdowns, to look for a bounce. We're basically rotating to a more aggressive portfolio on a drawdown, looking for a bounce, looking for that 9 consecutive days to come close to holding that within the next few days for a bounce in the middle of the month. Two-sided price action. Let's look at the charts now as well. We talked about how the ECB, European Central Bank, is reducing its bond buying program, which would lead to tapering. Every time the Federal Reserve and central banks start to taper, the markets have more two-sided price action. So AT 2021 got short, AT 2021 short only got short yesterday. We added 60-minute breakout to this portfolio. It did well. Shorting yesterday, short, stopped out on that short again into the close. And so good comeback into the end of the day. We do have those long-only strategies like 60-minute breakout, which has had 1, 2, 3, 4, 5, 6, 7 losers in a row. Now we're at a level, I think, where even if the market is going to be more bearish, it has more two-sided price actions to bounce back and counter trend rallies. In Q, EVP1 got short into the close, but the biggest losers yesterday were the 60-minute breakout A, 60-minute breakout B, and these are 4 contract trades, so the values for the profit and loss are based on 4 contracts, not one. And then stock index swing. These were the 4 strategies yesterday that hurt us the most, and we're down. The rest of the strategies were pretty good. Crude oil made a little yesterday back, and yesterday's price action in the stock indexes reminded me of Thursday's price action in crude oil, up, down, and so we kind of had that same price action in the stock indexes with this leg not being as high. So the stock indexes could bounce back on Monday, and in which case our 60-minute breakouts would probably do really well, capturing the counter trend reversals, or if it rolls over, we have strategies to continue to short the market. So That's the opportunity that we have here, the 50K portfolio trades. No trades yesterday. Let's look at the portfolio calculator again for all of the portfolios. And once again, here is the 200K portfolio. 9 losing days in a row max. We're at 8, and so 38K drawdown. Looking for that 40K bounce back, roughly speaking. And then if we look at the 50K portfolio, it's what it's done is very cyclical and very normal, and so it's a less aggressive portfolio, more conservative, 10 strategies, and so it's been at these levels before. It has not made a worst case drawdown, and like I said, it trades less. It didn't trade at all yesterday, and so this could be a good bounce back point in that cyclical drawdown curve. Always good to get in on a drawdown rather than an equity peak and look for that bounce. Let's look at the rest of the portfolios while we're here. I know a lot of micro traders. We'll start with those. Micro portfolio aggressive. It's holding on its worst case drawdowns by about $1,500, down on its second month in a row so far. But we just started the month, so more volatility, but still pretty cyclical in that drawdown path. So that is one to consider, the aggressive micro portfolio. The micro portfolio conservative, which mirrors the 200K portfolio that we just transitioned from. It bounced back a little bit yesterday. It just trades. It doesn't trade all the markets that the 200K portfolio was trading because it trades just the 1/10 micro liquid contracts, even S&P, NASDAQ, gold, and crude oil. And it made a worst case drawdown, kind of like the 200K portfolio, down on the month still. But this is a one contract, one micro basis, and so lots of room to bounce back. If you want to get on trading one micro on these strategies, you have this bounce back opportunity of about $2,200 per micro. You could also trade that on the minis. You could trade that, and so it would be a $22,000 bounce back on that. Stock index portfolio 27. Here's another one that has not made another worst case drawdown in this cycle. So the stock indexes are the ones in this portfolio are doing well. Even though they're down 79.50 on the month, it's a normal drawdown. You can see that this worst case drawdown happened here on February 23rd. This is similar to what our current portfolios are doing. Volatility expanded, made a new worst case drawdown, and then it's bounced back and had a decent year. I like more diversity than just stock indexes, but some people just like to trade the stock indexes, and you have a lot of methodology diversity. Still up 80K on the year, and $24,000 drawdown happened in February on just a 27 system strategy. And that covers all, I think, of the well, we didn't go over the all strategy access. So all strategy access, $49,000 drawdown, down 21,000 on the month, up 208 on the year. And you can see this went through some incredible chop, made a worst case drawdown here, big bounce back, and then it pulled back again, looking for another bounce back to equity peaks based on our monthly cycle patterns of chop versus trend. And short list 51, it's at a worst case drawdown, 25,471. It's a small drawdown for 51 strategies. If you think about it in terms of drawdown per strategy, it'd be about $500 drawdown for all strategies at the same time. Let's see here. So just like that stock index portfolio I'm showing you, made that worst case drawdown based on new levels of chop at higher index values. And let's look at gold's been a big a market that's really chopped a lot and really hurt us as well. Stock all strategy access 51 plus 7 new, $31,000 drawdown. Right there, new levels of chop. And so those are the results for the portfolio calculator. And I know most of you trade the 200K or the 50K or one of the micros, and so we went over those first. I also want to show you another perspective in the 200K portfolio. I did a save as, download, scratch too. So I'm going to go in here and delete some of these systems. We spent a lot of time talking about the stock indexes, and the stock indexes portfolio is actually not at a worst case drawdown. What happens if we say get rid of gold? What if we get rid of gold and crude oil? those markets have been choppier, more choppy than normal as well. Let's take a look. You see it's $34,000 drawdown. It's in a current $17,000 drawdown. And let's go back to the drawdown curve on this. So it's not, if we got rid of gold and crude oil, I might make a separate video for this as well, because this is towards the end of a long video. And but there is a normal drawdown, just these quick spikes. And so gold and crude oil have been, we don't talk as much about those markets. We have more stock index strategies. There's more information related to stock indexes. It's a higher level of interest in stock indexes. But when you take a look at this portfolio, what is the real culprit? And the real culprit in this drawdown really has been the way gold has moved and the way the crude oil market has been choppy as well. So that's something to consider as well. Going forward, we'll be taking a deeper look at that and way to manage this. You hate to just start trading this portfolio right here and risk another worst case drawdown at this point. Look for a bounce and then maybe make some adjustments on that. So wanted to share that with you. I'm going to probably make another short video just based on this.